Welcome back to the Pro Ticker Podcast, your Friday morning edition, covering major financial magazine headlines, everyone.
It is great to be back, although looking at the screens this morning, I think intense might be the understatement of the year for what we have to cover.
Intense. If you've looked at your portfolio in the last 48 hours, you probably need a stiff drink.
Yeah.
Not a podcast.
Right.
It has been absolute chaos. I mean, we are seeing a sea of red, panic in the streets, and a lot of people asking the same question. Is this just an illogical panic, or has the apocalypse actually arrived?
It's the question of the hour, really. And to get to the bottom of it, we've pulled a massive stack of reports fresh off the wire this morning from CNBC, Bloomberg, and Reuters.
That's quite the stack.
It is. We are looking at a tech sell-off that is, dragging everything down with it, geopolitical tensions spiking, and some truly wild volatility in commodities.
I looked at this stack this morning, and honestly, I didn't know where to start. You have tech crashing, silver spiking, aircraft carriers moving. It feels like everything is happening at once.
Yep, it does.
Help me make sense of the priority here. Is there a single thread pulling all this together?
I think there is. It's a reality check. For the last 2 years, the market has been running on this assumption that AI is a magic money printer for everyone.
Right. AI lifts all boats.
Exactly. Well, this week, the bill came due. So we're going to map this out in 3 main parts. First, the trigger. The specific move by Anthropic that is threatening to destroy the software business model.
This is apocalypse.
Right.
Done.
Then we follow the money. Big tech is gambling $650 billion on infrastructure, and investors are finally balking at the price tag.
Okay.
And finally, we'll look at the ripple effects, how this repricing of risk is hitting everything from Bitcoin to the geopolitical chess game between, India and Iran.
Okay, let's start with the panic then. The S&P 500 Software and Services Index fell over 4% on Thursday. It's down about 20% for the year.
20%.
We are only in February. Usually when I see a drop like that, I assume the Fed raised rates or inflation spiked.
Yeah.
But you're saying this is about a product launch.
It is entirely about a product launch. Anthropic released new AI tools for its Claude Cowork agent.
Claude Cowork. Even the name sounds like it's coming for your cubicle. But hold on. We've had chatbots. For years, we've had ChatGPT, we've had Gemini. Why did this specific release cause Salesforce, LegalZoom, and Thomson Reuters to just fall off a cliff? What is different here?
That is the key distinction. Until now, AI has been a co-pilot. It helps you write an email. It summarizes a PDF. You are still the pilot.
Right.
The Claude Cowork update is different because it introduces autonomous agents. These are designed to handle complex professional workflows from start to finish. We're talking legal research, tech research, CRM management, heavy analytics.
So it's not just helping me manage my CRM, it's doing the CRM management.
Correct. And this scares the market because of the seat-based business model. Think about how a company like Salesforce makes money. They sell licenses.
Right.
Per user. Exactly. If you have a sales team of 50 people, you buy 50 seats. They want you to hire more people, so you buy more seats.
Right. That's the growth metric. Net
Right.
retention, user expansion, all of that.
Now, imagine a scenario where Goldman Sachs or a massive law firm says, you know what? We don't need to hire 50 junior analysts. We're going to buy 5 AI agents from Anthropic instead.
Then Salesforce sells 0 new seats.
Or worse, they start canceling existing seats. If AI stops headcount growth, the entire valuation metric for the software industry, it just breaks.
Ah.
And that is why you saw stocks like LegalZoom and even the Indian IT giants like Tata Consultancy and Infosys get hammered. The market is suddenly pricing in a future where software isn't sold to humans anymore.
It feels a bit reactionary, though, doesn't it? I mean, people have been predicting AI will take our jobs since 2023. Is this actually happening now, or is Wall Street just hyperventilating over a press release?
That is a fair skepticism, and usually I'd agree with you. But this time, we have receipts. There was a source in our stack from CNBC, an exclusive report on Goldman Sachs that takes this from, theoretical to very concrete.
This is the part about the embedded engineers, right?
Yes. And we need to pause on how rare that is. Goldman Sachs is a fortress. They are notoriously secretive. They do not just let third-party tech startups camp out in their headquarters.
No, absolutely not.
So the fact that they have had Anthropic engineers physically embedded inside the bank for 6 months, that signals a massive cultural shift.
So they've been building this in secret. What exactly are they building? Because if it's just a better chatbot for customer service, I'm not impressed.
It's not customer service, no. They are building autonomous agents for trade accounting and client vetting. That is compliance work.
Wow.
That is high-stakes, rules-based, complex back-office work. And Marco Argenti, the CIO at Goldman, is explicitly calling these digital coworkers.
Digital coworker. That phrase sends a shiver down the spine. But let me play devil's advocate here. Goldman is a bank that relies on trust. Are they really letting an AI agent handle compliance? I mean, what happens when Claude hallucinates a regulation that doesn't exist?
Well, that's the breakthrough Argenti highlighted. He noted that this new version of Claude wasn't just good at coding, it was capable of reasoning through complex problems and checking its work.
Ah, okay.
And here is the aha moment for the market. Goldman explicitly said the goal is to constrain headcount growth while their revenue surges.
Okay, that is the smoking gun. Constrain headcount growth.
Yeah.
If I'm a software investor, that translates directly to constrain software license growth.
Precisely. That is the bear case. Analysts are warning of massive margin and pricing pressure. If an AI agent costs pennies on the dollar compared to a software suite plus a human salary, software prices have to come down.
But surely not everyone agrees with this end-of-days narrative. I mean, we saw a note from Wedbush Securities in the stack that seemed to think this was all a bit overblown.
Right, the Wedbush team. They are calling this sell-off an Armageddon scenario that is, in their words, totally detached from reality.
So what's their argument? That the tech just isn't good enough?
Their argument is more about inertia and stickiness. Think about a hospital system or a bank like Goldman. They have decades of data ingrained in their current infrastructure. SAP, Oracle, Salesforce. You don't just rip that out overnight because a cool AI agent came out.
No, you don't.
It's the turning a battleship argument.
That makes sense. It takes corporations 3 years just to upgrade Windows. They aren't going to replace their entire workforce with a beta software next week.
True, but the market isn't pricing for next week. It's pricing for the next 5 years, and the direction of travel is clear. And speaking of the cost of that future, we have to talk about the second pillar of this sell-off. The capex shock.
This is the number that made my jaw drop. $650 billion.
It's a staggering figure.
According to Bloomberg, the hyperscalers, Alphabet, Amazon, Meta, Microsoft, they're forecasting a combined $650 billion in capital expenditures just for this year, 2026.
To put that in context for you, that is more than the GDP of Sweden or Poland.
Wow.
Just being poured into infrastructure in a single year.
What are they actually buying with all that? Is this just NVIDIA chips?
It's everything. It's the chips, yes. But it's also land for data centers, it's copper for the networking, it's massive cooling systems, and crucially, it's energy contracts. They are building the physical backbone of a new economy.
But here is what I don't get. Amazon shares tumbled 8% because of this. But Amazon is a profitable company. If they have the cash, why is the market punishing them for investing in their own future? Shouldn't investors be happy they are innovating?
It comes down to two words: depreciation and margins.
Break that down for us.
Okay, so when you spend $200 billion on equipment, which is what Amazon is projecting for 2026, that equipment loses value over time. That depreciation hits your earnings report. So investors are looking at this and saying, you are spending a fortune, which will hurt your profits today for a payoff that is, theoretical and years away.
And Amazon missed their earnings estimates too, right?
Yes, and that was the double whammy. Their Q4 operating income missed expectations, and they announced they're spending way more than anyone thought. I mean, the estimate was $146 billion in capex.
And they came in at
$200 billion. That is a $54 billion surprise.
That is a lot of money to find in the couch cushions.
It is. And investors are asking, is this discipline or is this panic?
It feels like panic. It feels like FOMO, fear of missing out.
Gil Luria at D.A. Davidson describes it as a prisoner's dilemma.
A race they can't afford to lose.
Exactly. Even if Amazon thinks $200 billion is too much, they look over at Microsoft spending $105 billion and Alphabet spending $185 billion, and they say, if we don't spend this, we lose the AI war and become irrelevant in 10 years.
So they are forced to light money on fire just to stay at the table.
In the eyes of short-term shareholders, yes. It's a transition from AI lifts all boats to AI is an incredibly expensive arms race that might just crush your margins for the next 3 years.
And when risk gets repriced like that in tech, it spills over. It's not just stocks. And this brings us to the risk-off ripples in crypto and commodities. Because if you thought the NASDAQ was having a bad week, Just look at Bitcoin.
Yeah, the digital gold narrative is taking a serious hit right now.
We were just talking about Bitcoin hitting all-time highs recently. What was it, 126,000 back in October 2025.
That's right.
Now, it's officially in a bear market relative to that high.
Yeah.
It dipped below $61,000 on Thursday.
It's behaving exactly like a tech stock.
But isn't the whole point of Bitcoin that it's supposed to be uncorrelated? A
Yeah.
hedge against the system?
That's the sales pitch.
Mm-hmm.
But the reality of the market structure is that the same institutional investors who own NVIDIA and Microsoft also own Bitcoin. So when they get a margin call or get scared about the tech sector, they sell their most liquid, risky assets first.
And Bitcoin is first on the chopping block.
It falls into the risk asset bucket, not the safe haven bucket, at least for now.
Speaking of volatility, let's talk about silver. I saw the chart on this, and it looks like a heart attack monitor. It dropped nearly 10% on Thursday, then snapped back up 4% Friday morning. What on earth is happening there?
This is a lesson in market mechanics. Analysts are calling silver a meme stock right now because of the liquidity issues.
Okay, explain liquidity like I'm 5. When you say the market is thin, what does that actually mean for the price?
Hey, okay. Imagine a crowded room with 1,000 people. If one person starts screaming and runs for the exit, it doesn't matter much. That's the gold market. It's huge. It's deep.
Sure.
Now imagine a room with only 10 people. If one person screams and runs, 10% of the room just left. That's silver. There aren't enough buyers and sellers to absorb the panic orders, so the price swings wildly.
So it's not that the world suddenly hates silver. It's just that there weren't enough buyers to catch the falling knife.
Correct. But the long-term bull case for silver is still interesting. It's industrial. Solar panels, electronics, AI chips, they all need silver. But right now, it's being traded on pure emotion.
And yet, despite all this chaos, there was one note in the stack that really surprised me. JP Morgan. They're usually the sober adults in the room, but they put out a note comparing Bitcoin and gold that sounded, well, surprisingly bullish.
This was a fascinating pivot. Despite the crash we just discussed, JP Morgan strategists suggested that Bitcoin might actually be a better long-term bet than gold.
Wait, really? While it's crashing?
Their argument is generational. They believe digital gold is finally usurping physical gold as the preferred store of value for younger generations. They are telling clients to look past the current volatility.
Wow.
It's a bold call to make when the price is tanking.
Talk about buying the dip. Okay, let's zoom out. We've talked tech, we've talked finance, but there is a very real physical danger brewing that is also driving this risk-off mood. We need to talk about the Middle East, and specifically the news out of Iran.
This is the geopolitical shadow hanging over everything. The U.S. virtual embassy in Iran issued an alert that was just incredibly blunt.
What did it say?
Leave Iran now.
That's not a standard travel advisory.
No.
Yeah.
And it comes in the context of high-stakes talks happening in Oman, where trust is reportedly at 0. At the same time, the U.S. has deployed the aircraft carrier Abraham Lincoln to the region. Bloomberg called it a massive armada.
Why does this matter to the average investor listening right now? Is it just about oil?
Primarily, yes. Brent crude popped up to around $68 on the news. If things escalate, oil prices spike. If oil prices spike, inflation comes back.
And if inflation comes back, the Fed can't cut rates, and the tech companies we just talked about get squeezed even harder.
It's all connected.
However, amidst all this doom and gloom, and frankly, it's been a lot of gloom, there was one bright spot. India.
India is playing a fascinating game right now. While the U.S. and China are locking horn and the Middle East is on fire, India is positioning itself as the Goldilocks zone.
The headline number was the Boeing deal. India is talking about buying up to $80 billion in Boeing aircraft.
That's huge for Boeing, obviously, but look deeper. Why are they doing this? It's part of a larger trade push where India might buy $500 billion in U.S. goods over 5 years.
Is this just because they need planes, or is there a strategy here?
It's a geopolitical hedge. India runs a trade surplus with the U.S. They know that if the political winds change in Washington, they could get hit with tariffs. By buying $80 billion in planes, they are effectively buying insurance. They are balancing the trade scales to keep the U.S. happy.
That is incredibly savvy. We'll buy your planes, you keep your markets open to our IT services.
Exactly. And at the same time, the Reserve Bank of India kept rates steady at 5.25%. They're forecasting 7.4% growth. They're using these trade deals to build a fortress around their economy while the rest of the world deals with volatility.
It's a stark contrast. The U.S. is panicked about AI replacing jobs. India is growing at 7% and buying fleets of aircraft.
It highlights that the global economy isn't a monolith. But we should briefly mention one other G7 nation that isn't having such a good week: the UK.
Right, Keir Starmer and the bond market.
The gilts, yeah. British government bonds took a hit because of some political instability regarding the appointment of Peter Mandelson as ambassador to the U.S.
This is regarding the Epstein links.
Yes. And the reason an American listener should care is that it shows how fragile the sovereign debt markets are right now. If a political scandal in London can rattle the bond market, it shows that investors are nervous everywhere. There is no risk-free trade right now.
So let's try to land this plane. We've thrown a lot at the listener. We have
Yep.
AI agents taking jobs, tech giants spending $500 billion, crypto crashing, and aircraft carriers moving into position. What is the takeaway?
If we synthesize this, I think we are seeing a massive repricing of risk. The market is moving from a phase of hype to a phase of execution.
The honeymoon is over.
The honeymoon is definitely over. For the last year, you could just buy the word AI and make money. Now the market is realizing that AI picks winners and it destroys losers. The difference between companies that control the AI, like the ones spending that $650 billion, and the companies that get replaced by the AI, like the SaaS companies, is becoming the single most important distinction for investors.
And that leads to the big question I want to leave everyone with. We started with Goldman Sachs. They're using digital coworkers to halt hiring. If one of the most profitable, complex banks in the world is successfully doing this, what happens to the broader economy?
That is the multi-trillion-dollar question.
Are we looking at a massive efficiency boom that makes the economy more productive than ever? Or are we staring down the barrel of a deflationary spiral for the white-collar economy? Because if nobody is hiring junior analysts, who is buying the products?
And who is renting the apartments in New York and London? It changes the plumbing of the entire economy.
Something to think about over the weekend while you check those charts. That's it for this deep dive. We'll see you all Monday morning with new headlines from major financial magazines.